Hello, I'm Kim Stafford, and I'm here again with PIMCO Group CIO Dan Ivascyn to give you an inside look at some of the recent discussions taking place within PIMCO's Investment Committee, or IC. Dan, thanks for joining us today.
Thanks, Kim.
We named our 2025 cyclical outlook Uncertainty is Certain to highlight the range of potential policy changes and economic outcomes under the new U.S. administration. We've seen some of this uncertainty play out with tariffs at the forefront. How should we think about the global implications of this global trade uncertainty that we're seeing?
Sure. So I think you're right. We are in an uncertain time. Uncertainty can be both a risk or an opportunity as well. The fact that a key aspect of the president's agenda is tariff policy. You do not only have uncertainty here in the United States, but you have a lot of uncertainty in terms of relationships with other countries, impact on markets. And that's creating not only a lot of localized volatility, but volatility across countries, across sectors, across yield curves. And that's a great opportunity as well. So I think the key theme, going into this year is to have a healthy degree of humility around the uncertainty, acknowledge the uncertainty, but look to take advantage of the full global opportunity set, both within the liquid, higher quality areas of the market, as well as in some of the more credit sensitive areas as well.
Great. Well, we've seen some sharp bouts of market volatility over the past month in the wake of policy shifts, but also threats to the AI investment boom. How should investors think about this volatility, and how should they evaluate both opportunities and risks in this environment?
Yeah, I think the AI piece is important as well. Yes, we have a lot of political uncertainty, policy uncertainty, geopolitical uncertainty, but you also have this highly innovative technology that's disrupting traditional models, likely to continue to disrupt models. And anytime you have a disruptive technology combined with a lot of macro uncertainty, there are going to be periods of disappointment. And again, I think we need to prepare for the fact the market's going to be volatile. And again, an active asset manager can benefit from that volatility. Without volatility, it's hard to generate return versus passive alternatives. And it's been pretty target rich of late. I think that's been borne out, in terms of the performance across strategies, and the future looks bright as well.
Dan, can you talk about the implications of inflation and the outlook for Fed policy?
Yes, so our inflation outlook for the remainder of the year is that we still are well above central bank targets, or at least in the closer to 3% than 2%. That creates a lot of uncertainty for the Fed as well. Our base case view on the Fed is the Fed's going to be on hold for the foreseeable future. The good news from an investment perspective is a lot of the optimism around the Fed, multiple cuts for 2025 have now been priced out of the yield curve. We're back to a point where there's only a slight expectation of modest cuts later on in the year. So we're at a point now where risks are much more symmetric, and therefore we like the intermediate part of yield curves a lot more than we did just a few months ago. We do think equities and the credit sectors may be a little bit complacent, and that's why we're being a bit more defensive in that area.
So talk about fixed income amidst this volatility in terms of range of outcomes. How should investors think about the asset class?
Sure. Starting in high quality fixed income, a lot of noise, a lot of uncertainty, even uncertainty about the Fed, inflation still being above target. But I think it's important for a fixed income investor, and I try to remind myself of this every day, that with high yields and yields that look attractive from a historical perspective, both nominal yields and inflation-adjusted yields, returns are fairly predictable and stable over a 3 and certainly a 5-year time horizon. Second point that's critically important is that, yes, there's increased chatter around risks to higher inflation because of tariffs, risk to higher yields because of expansive fiscal policy or even increasing deficits. But I think it's important to note that fixed income's cheap, attractive from a historical perspective. Equities and credit spreads are not. They're quite tight. You don't have to take a tremendous amount of interest rate risk. You don't have to extend out the curve to very, very long maturities. You can focus on an intermediate term duration portfolio with a little more interest rate risk than you would have had a few years ago when there wasn't this valuation cushion. And then it's a very attractive tactical trading environment to add some incremental alpha through smart asset allocation decisions, being tactical, being creative, and putting together a portfolio and shifting that portfolio over time as well.
The U.S. economy remains strong, even though interest rates remain elevated. So with this backdrop, how do you assess the health of credit markets, both public and private?
Yeah, well, they're tight. Public markets are tight. Private markets are tight. When you adjust for the quality of covenants, particularly in some segments of the private markets, they're probably a bit tighter than they would appear. So, what we've been trying to do, and we've talked about this before, is to put together a credit portfolio, whether it's on the public or the private side of our business, that's sufficiently robust and resilient if we're wrong in terms of our growth outlook, and there are negative shocks or other factors that can impact credit. So, this has been a time over the last few months where spreads are tight, markets are extremely liquid, and you can shift out of the most economically sensitive areas of the market. You can avoid some of the floating rate, lower quality credit markets in favor of markets that have better fundamentals. And then, as we've talked about repeatedly over the last few years, the consumer balance sheet remains strong. Home prices have gone up a lot. So if you can source seasoned mortgage collateral, if you could lend to the consumer, again, similar asset allocation themes in the public and private areas of the market, you can match the yield in certain sectors that have more risks that we think are currently being underappreciated and have downside protection. The last point I'll make just relates to other types of proxies for credit or alternatives to credit. Agency mortgage-backed securities continue to look attractive. It's so rare to see agency mortgage nominal spreads wider than investment-grade corporate spreads. It almost never happens. But when stocks go up a lot, when there's this rush to target credit assets, and when interest rate volatility is elevated, you do have this situation where you can buy a very high-quality asset, a very liquid asset, an asset with a little bit more complexity to earn incremental spread with a significant advantage in more negative economic scenarios. There's lots of other examples of this on a global basis. And again, it's a pretty target-rich environment, not only to deploy capital, but also to just enjoy the benefits of attractive yields and even equity-like returns in some of the higher risk areas of our credit opportunities set.
Great. Well, thanks very much, Dan. And thanks to all of you for joining us. We'll see you next time.